Hi, I'm Jim Jubak, and welcome to this week's Trend of the Week video. This week's trend is, hey, Minsky Moment Ahead? Okay, if you don't know what a Minsky moment is, well, I don't know where you've been for the last 20 years. Okay, Minsky moments are, Hyman Minsky was an economist who studied credit cycles. He died in 1996. He did not call this after himself. In fact, this was not called a Minsky moment until 1998, when Paul McCulley, another economist who was actually working with the Russian Ruble crisis and the Asian currency crisis, said, hey, Hyman Minsky has described this situation, and we can learn a lot by looking at how he described credit cycles. One of the things that Minsky said is that in a capital market, credit cycles tend to have their own internal dynamic that runs from a point where credit is abundant. Banks have a lot of money and are lending. As that part of the cycle goes on, you can think of it as ascending curve. As that part of the cycle goes on, banks tend to get overconfident. They relax their credit standards. Hey, it's worked in the past, so why don't we just push more money out the door? And at some point, those credit standards get sufficiently relaxed so that an event like the failure of a Silicon Valley bank or a Credit Suisse hammers them, and they take unexpected losses. And then what banks do, and this is the important thing for where we are now, what banks then do is not say, hey, we'll go back to where our credit standards were at the beginning of the cycle. They say, oh no, our credit cycles are too lax. And they get tighter than they were before they started lending. So what you really get is a constriction of credit at exactly the point where the market might say, where the economy really needs credit. So you can get a sort of starvation effect or a choking effect right then on the economy because of a contraction in the credit cycle caused by this ebb and flow in bank credit standards. As I said, the first crisis that was dubbed this was the 1998 Russian Ruble crisis and the Asian currency crisis. Certainly 2007, 2008 was an example of this, the subprime mortgage crisis. The question right now is whether we're going to see some kind of contraction. We've got a lot of contractionary forces. The Fed is raising interest rates, but also cutting its lending. Its quantitative easing policy program is winding down. They're selling off parts of their balance sheet to try to reduce it. All of those contract the money supply. If you'll notice that one of the first things that the Fed and other central banks did in the Credit Suisse crisis and the Silicon Valley Bank crisis was to go out to the market and say, hey, we're going to provide all the liquidity you need, lots of dollars, lots of dollars, lots of dollars. Market isn't sure that they're really convinced of that yet, but so that's the contractionary force there. And the other one is the contractionary force from the Minsky description of the credit cycle. And the place where that really comes to bear right now, one is in emerging markets, developing economies, where the IMF has come out and said, hey, these countries have a real debt problem. Their economies are not growing very fast. They took on a lot of debt. And now the big bank that lent the debt, which was China, is saying they won't renegotiate and they're not going to put any more money in. So you can see a credit crunch there. The other one is in the sort of the entrepreneurial economy, startup companies which are having trouble raising cash, and certainly trouble raising cash at elevated valuations. Stripe, which is a online payment processor that I use for my site, very good, very successful, one of the real coming stars of fintech. And not yet public, but recently did a round of another private round at a valuation about 50% lower than the one before that. There are reasons sort of specific to the company why that valuation was lower, but also that's not a really good trend. You don't want to raise a fifth round at a lower valuation than you're raising your fourth round. Company's supposed to be getting more valuable as you go along. So those are two places where I think if we're going to get a credit crunch, they're going to show up first. So make sure, if you have emerging market exposure, that you're comfortable with the level you have, because I think we're going to see pressure there. And B is if you have companies, promising technology companies that you've socked away because you love their future out there, you need to look at their present and see whether they have enough cash flow to keep going. In other words, be careful out there. Thanks very much for watching. If you like this video, please give it a thumbs up. You can subscribe to my YouTube channel. It's free. You get a notification when we do our next one. If you want more of my stuff, you can go to my free site. That's gbagpicks.com, 3 portfolios, or my paid site, gbagam.com, which has 6 portfolios, including some longer-term plays of exactly the kind of technology stuff that we're talking about, as well as doing some options and ETFs. So thanks very much for watching.